The economy is about to enter the point of no return. Hey, everybody, you're watching Bull, Boom, Bear, Bust. My name is JJ, and we're back with another dose of economic reality as usual. Let's go ahead and get right into it here. We got a lot of news to get into, a lot of data, a lot of charts. Actually, I've got the screen share ready to go here to get into today's report. Please make sure you hit the like button to help us out here and get this video a little bit of traction, hopefully here on Saturday, and help us stay alive here and help me keep doing this. Help me keep on creating videos for you. Keeping on, as they say, right? Let's go ahead and start right here, and we're going to talk about what's going on behind the doors of this building right here. And of course, that has to do with interest rates, and there's going to be a decision really soon as to what to do with interest rates. I think they're going to be afraid to raise rates even a fraction of a percent. I think they're going to do another pause. Of course, we'll have to see, but that is coming up very soon. Now, many people out there, and maybe even you, are asking, hey, what's the deal? Inflation is still way above 2%. We're supposed to be fighting inflation. And if it's still above the target, which is 2%, why are we not raising rates? What's going on here? Well, what's going on here is they're backed into a corner. Markets are already starting to fall apart. We're going to talk about the stock market here in a few minutes. Consumers are falling apart. They've been falling apart for a while, but consumers are getting deeper into the debt abyss. And we're going to talk about that here in a bit as well. And as everyone knows by now, the predictions here came true. We are escalating into this war here. The U.S. is now involved, including strikes and even injuries now for U.S. Troops overseas. And we think this war is going to escalate in something pretty massive. And it's going to come here to the shores of the U.S. And I think this is going to be used as the excuse for pulling the rug on this economy. Now, other people are out there saying it's going to be an excuse to just pump more money into the economy, and they're going to try to inflate their way out of this. I think it's more going to be more of a rug pull, and therefore some of these bubbles are going to pop, and we're going to see asset prices coming down. All right, so that's yet to be seen. A lot of things could change, but right now things are escalating, and I think they're going to continue to escalate as far as the conflicts and how we, the United States, are involved in these conflicts here globally, more than just financially. Now we've got troops all over the world already with all the different bases, but now on top of this, we have direct involvement in what's happening over in Syria. It's going to expand into the Middle East. Anyway, that's going to be a big game changer, I think, for the economy. But let's go ahead and get into this. Let's talk about consumers. Consumers are having a hard time for the most part. Of course, you have a small percentage of the population out there that's actually doing very, very well. But it's interesting. I just saw an article a few days ago about how so many people now are millionaires. And what they're talking about is net worth or paper worth, right? So if you look at home equity, a lot of people are millionaires, especially here in California. If you bought even a 2-bedroom, 2-bath home, 800 square feet in some parts of California, you're considered a millionaire. Because China's real estate bubble is absolutely collapsing. In 2008, when the subprime mortgage crisis nearly ended modern capitalism, housing was 8% of U.S. GDP, while housing is 25% of China's. This is an epic meltdown, and it's just the beginning. Meanwhile, in the United States, inflation is so high that the Federal Reserve is talking about raising interest rates further, choking the credit out of the economy completely. Everything is expensive. Gold is perfect for this environment, but it is at near all-time highs already. So I want to present a company called Gold Mining Inc. trading on the New York Stock Exchange under the ticker GLDG. The reason is that this company trades at multi-year lows, extremely cheap. Their gold resources are only worth $1 per ounce. If you go to wealthresearchgroup.com/cheap gold, there's an entire presentation explaining how this company is effectively 80 or 90% more discounted than anything out there. If you're bullish on gold, I urge you to stop everything you're doing and download this carefully drafted report now. Gold Mining Inc. is a junior resource company trading under the symbol GOLD on the TSX Venture Exchange and GLDLF on the OTC markets. The company is focused on the acquisition, exploration, and development of resource stage gold projects in the Americas. Goldmining.com. Link down in the description of this video of the equity. But that is going to vanish if we see the rug pull that I think is going to actually happen, because it's going to be such widespread panic and economic and financial devastation across the globe that I think you're going to see a lot of these bubbles go bust. But let's go ahead and get into this. Consumers are not doing good. Take a look at this chart right here. And let's start right here. This is out of the Bureau of Economic Analysis. And this is the personal savings rate. It only looks at 4 months, but only from these recent 4 months here, we can get a pretty good idea of what's happening with the US consumer. First, let's go just read the description here. Most of you know what this is, but let me just read it for those of you that don't. The US personal savings rate is personal saving as a percentage of disposable personal income. In other words, it's the percentage of people's incomes left after they pay taxes and spend money. Now, some people don't have anything left. Some people have less than nothing and they have to take on more debt. But if you average everything out, including even the top 10% of the wealthy here, this is what's going on here. It is dropping continually. We go back to June, it was 4.9%. That was already low. July, 4.1%. So from 1 month to the next, it dropped 0.8%. July to August, not as big of a drop, from 4.1 down to 4%. But look what happened from August to September, another 0.6%. Now, is that going to get better or worse as we go into the end of 2023? Well, I think it's very likely going to get worse, because what do people do during these months? They spend a lot of money on travel. They spend a lot of money on gifts, and they're going to be spending a lot of money on just filling up the tank because fuel prices are going up, partly because of what's happening with the conflicts that we're seeing on different parts of the globe. So it looks to me like consumers are on their way to being very, very low in funds. It's already low, but if we continue these types of drops, where 0.8%, 0.6%, consumers could be wiped out by the middle of next year if this pace continues, right? If we see like a few more months of 0.8%, that remaining 3.4% could get eaten up very, very quickly. And this is what I want people to pay attention to, not necessarily spending, because spending, for the most part, can just be people swiping their credit cards, going further into debt. But a good gauge and a true picture of this is the savings rate, how much money people have after paying their monthly expenses. We can also see this in other data here that we talk about. We look at the delinquency rate for automobiles exploding higher, the delinquency rate for credit cards exploding higher, foreclosures starting to increase. They're coming off of a record low, a multi-decade low, so they're still not high at all at this point, but they are coming off the bottom and definitely increasing pretty significantly. And these are all signs that the consumer is getting tapped out. We see the savings rate, in that previous chart here. So it shouldn't be a mystery to try to figure out what's happening here. But if you look at the business channels, the business networks, they're really not talking about this very much. Maybe a little segment within a segment, or a little segment within a show about a different topic, right? Something about stocks. But this is what's happening, folks. And the US consumer is the biggest part of the economy when you look at GDP and the gross domestic product. Now, a bigger part of that recently has been this war spending and all this aid and funding we've been providing. And some people are saying that's going to eclipse the what the consumers are spending with all the money that we're sending all over the world. I haven't seen the latest on that. It's so much right now. It's really hard to keep track of. But the bottom line is they're going to try to prop the economy up, I think, with the GDP number that looks better when the government spends money. And when we're spending money on war, that actually adds to the GDP. If banks continue to loan out money, we're going to see consumers still able to spend. But just because you can spend on a credit card doesn't mean things are all good and rosy when you look at the savings rate, right? So just wanted to kind of paint a picture on that for you. Let's transition a little bit to this next topic here. And just as we predicted, the stock market is continuing to go into correction territory. In fact, if you look at the past 3 weeks here, this is the major indices are on track to fall for 3 straight months. And I'd like to go ahead and bring up a chart here of what's happening here. This is out of the journal, and we can see all indices are in correction territory. And this is no surprise, no secret. I called the top of this back at the end of 2021, early 2022. We haven't seen the highs that we saw in late 2021, early 2022 get eclipsed yet, and I don't think it's going to happen. Um, I think finally the stock market is pricing in here some economic reality. So be very careful what you're invested in at these times. It's a good time to be in cash, especially with the rates high and likely to stay high, even though the Feds seems like they're afraid to raise even a percentage, a fraction of a percentage. Now, with the ability here in the United States to create money out of thin air in digital format and basically flood the economy with money, we're able to stave off a recession. But that's just the definition of a recession that's put out there when you look at 2 consecutive quarters of negative GDP growth. And what happens is even when there's a global meltdown or a global freeze up, such as we had in 2020 with the health crisis, you can make recessions very, very brief just by flooding the economy with money. And we know that about 40% of all dollars in existence today were printed just in the past 3 years. And we're going to bring up a chart here that's going to kind of give you an example of how short recessions can be when you can just create endless amounts of money here. Let's take a look at this. Out of CNBC here, this is the recessions here in number of months that each one has lasted. And if we look back all the way to 1945, we see it was about 8 months. And does it go to the Great Depression? Nope. I guess they were too depressed back then to keep data to give us a chart on that. But we look to 2020, you would think that would have been one of the worst, right, with the global health crisis. No, that was only 2 months. Remember, the stock market corrected by about what, 35, 40%, depending on the index that you're looking at. But that was followed by the fastest correction or the fastest recovery that we had ever seen with all the money that was thrown at the problem. And of course, the national debt's exploding like never before. And we see just 2 months. The worst one was actually 18 months back between 2007 and 2009, the financial crisis, of course. But how does a global health crisis end up only being a 2 month recession? Well, the answer is simple, folks. That's record amount of money creation. And it gave us this inflation problem that we're still involved with today. So there's consequences for these things. Yeah, it was nice, I guess, to get out of that recession quickly, especially if you were someone that lost your job and ended up getting your job back. But look at the consequences that we're paying now for this monetary policy. And back to what we talked about towards the beginning of this video, many people are out there saying these conflicts that are happening right now is going to be the excuse to flood even more money into the system, even more money than in 2020. But see, I don't think that's going to happen. I think people are sick of inflation. They're sick of the high cost of living. I think the central bank knows that people are sick of it, and people are onto how this was created by the money printing. Some people are onto it. Unfortunately, not enough people are onto it. By the way, please talk to your friends, relatives, and people you meet about these things. I know it's not an easy thing to bring up, talking about the economy, but now it's easier than it's ever been because everyone's feeling the effect of the high cost of living and the effect of this money creation. And if you don't like to talk to people, maybe tell them about this channel, maybe have them come check it out. That would be highly, highly appreciated. I would thank you so very much if you did that. The point is, let's talk about these things to people if we can, because the more people know about what's happening here, the causes and the solutions, the better we're all going to be. But I think we're headed down a pretty dark path here as far as the global economy, not just the U.S. I don't think there's really much escaping this. I've gotten comments here on this channel from some people that have moved out of the U.S. and they say they're doing great in certain parts of the world, the Philippines and other places with lower cost of living. Too many to name, but there are places that are better. But it's going to be really hard to escape this, this global inflation problem here. Now, back to what I was talking about before I digressed a little bit. The S&P 500 just saw its worst 2-week decline of the year. The first 2-week decline of the year. So what's going to happen if war escalates? Is the stock market going to continue on the downward trend? Well, I think so. And there's no signs of this war de-escalating. In fact, more countries are getting involved. The U.S. is now involved in more than just financing and non-combative roles. We are now in combat roles and even striking certain targets. I believe it was Syria. So things are heating up very, very. Uh, was going to say nicely. I don't like to use the word nicely when it comes to these types of things in war, but things are definitely heating up, and it's going to get very, very interesting here. Somebody else is not so confident on where we're headed here down this economic path, and that would be Jamie Dimon, their CEO of JP Morgan, selling 1 million shares worth $140 million. So that's a sign. That's a sign that somebody high up there thinks things are not doing so good. That's not a vote of confidence for the economy. I would think that selling 1 million shares would be. And if Jamie was thinking that they were going to flood the economy with money and try to inflate their way out of this, you would think that he would think that about the stock market as well, and that the stock market was going to be inflated with all the money that's going to be thrown at this. But obviously, he doesn't think that. He's thinking more of what I'm thinking, and he's getting out, and he's thinking more of corrections, falling prices, falling asset prices, and lower uh, assets here down the road. Maybe even a crash. I mean, that's a pretty big sale. What do you think about that? Is he telling us something, or is this just a small percentage of his portfolio? It's pretty big. I mean, $140 million, even though Diamond's a billionaire, I believe. 140 million is nothing to shake a stick at. And let's shift gears a little bit here. Something on a personal level, just what I encountered this week. This week, I talked to two different people that sold their home here in California. So homes are still selling. People are still getting loans and buying homes, believe it or not, even though the sales volume is really slowed to a trickle. Homes are still selling. And the first person I know about that sold their home is a good friend of the family for many years. And they sold their home here in San Diego, and they're moving to Minnesota. So they're escaping the high cost of living. And actually, it's still pretty expensive over there. They said they rented a 3-bedroom place for 1,800, but that's actually a big savings because their mortgage over here was about 3,400 in California. So they're getting out from under it, and that's kind of the trend that I see just from people in my circle, the people that I talk to, are moving to places that are lower cost of living. Another person I just talked to, not really a friend, but somebody I was talking to at my mechanic, and this is another person that was just waiting in the waiting room, and he sold his home really far east county here, San Diego, a place called Hamul, and he's going to a small town in Indiana. And he said the same thing: the lower cost of living, basically escaping the high costs here and going to lower costs. And Midwest states are a big destination for people leaving the high cost of living here in California. So just what I'm seeing here, just locally, and people that I know here, people that I talk to. But home prices are coming down, not very quickly yet, and I think that's another reason why they're afraid to uh, do another rate hike, is because they see the corrections already happening. And when the savings rate's so low, like we talked about at the beginning, people are close to being emptying out their excess savings. And then if you also have home equity go down, and then the stock market corrects and people's 401k goes down, I mean, that's when everybody really starts to panic, right? So I don't think they want all these things to come down. I know they don't want all these things to come down at the same time. So they've got to balance this thing out here between keeping rates high enough to stave off further inflation, which they're not doing because we look at it every month and inflation's getting worse. It's a balancing act that's really, really, I don't see this ending well. Of course, Janet Yellen's out there saying it's a soft landing and everything's looking good because the consumers, they ran up debt last month, and the consumer is resilient, and therefore we're going to have a soft landing. Remember, she talked about that, which is just wild and insane here. Well, let's get down to a couple other little topics here that I thought were kind of interesting. Here's a reality star here, Kim Zolciak. I'm not sure if I pronounced that correctly. My wife used to watch this show. I believe it was called Housewives or something like that. And basically, look at this. She is, oh, sorry, I forgot to share my screen. She is begging a judge to cancel her foreclosure, claiming her children will be homeless. So, are we supposed to cancel her foreclosure? Is the judge supposed to cancel her foreclosure and not all the other people that have gotten foreclosed, especially if you go back to 2008? And what's going to be happening here in the next couple of years is going to be a lot of foreclosures. So, all we have to do is beg a judge and say that, the children will be homeless. Well, anybody that gets foreclosed, there's a chance they could become homeless. So why is she, the exception where she thinks that a judge should cancel the foreclosure? Right? What do you think about this? I just thought it was interesting that someone feels like they deserve to get their foreclosure canceled. But then again, if you look back at 2020, that happened for millions of people. They put a pause on that. Homes could not get foreclosed. So basically, maybe she's just asking for a continuation of what happened in 2020. Anyways, just thought that was interesting here. One more here. Look at this. Restaurant charging parents a $50 fee for kids that misbehave. Now, I know restaurants are trying to make money in a lot of different ways. Mandatory minimum tips, trying to always pitch dessert to you. Hey, do you have room for dessert? That's their job. Upsell, right? Sell you dessert, make you spend more. And it's a bigger tip, by the way, because of the tips percentage of your total bill. So of course they're gonna want you to spend more money. But a $50 fee when kids misbehave. According to the menu, the restaurant will add a surcharge to customers' bills if they are, quote, adults unable to parent. All right. This was a restaurant. Was it Georgia? Doesn't matter. Just a funny story, I thought. And oh, I looked down here. Yeah, it was Georgia. But this got me thinking, what is misbehaving and who decides what misbehaving is? All right, so a 7-year-old skips a couple steps. She skips. Is that misbehaving? A kid talks too loud. Is that misbehaving? What about a kid that runs for maybe 5 or 10 feet? Is that misbehaving? I mean, who decides what misbehaving is? Pretty interesting. I just wouldn't think parents would want to go to a restaurant that's going to charge this because, again, who decides misbehaving? Is it a kid drops their fork? Oh, you misbehaved, $50. Ding, ding, ding. They're going to be making a lot of money, but I think people would stop going there, or at least stop going there with kids anyway, to try to avoid that extra $50 charge. But again, hey, everybody's rich. Maybe they don't mind spending the $50 and they don't care if their kids behave badly because everybody's so rich. Remember, the consumer is resilient. Miss Yellen told us so. But go back to the savings rate at the beginning of this video and you'll see the true picture. And if things continue at this pace, it's not going to be pretty, folks, right? So buckle up, strap in, grab your popcorn, prepare whatever you want to title this, what we're doing here. Uh, Many people just say we're just staying ahead of the curve. Just knowledge is power. Information is good to have. So that's the main thing here. And people want to prepare in many different ways. Some people are hunkering down, not spending money. Other people are spending money faster than ever before. They figure, what the heck? It's not even worth trying to keep up the cost of living. So let's just have fun, party, travel, run up those credit cards, file bankruptcy, do it all over again. There's a wide gamut of ways people are dealing with this here. So, what are you doing? What are you doing to set up or prepare for this? And what are you doing right now as far as financial preparations? Are you buckling down, strapping in? Or are you just saying, forget about it? Let's just travel, swipe the cards, doesn't matter anymore. The country can go into endless debt. So can we as personal consumers. Well, not really, because we don't have an endless credit ceiling. All right, folks. Nice to see you. Thanks everybody for being here. Happy Saturday. I might be here tomorrow, but it's kind of a busy weekend in my household. We might get a short video in on Sunday. We'll have to see. But as always, thank you for being here. Keep stacking, everybody. And Bulls and Bears, we'll see you very soon. Peace.